Well, I must say the week's ending on a high note. After countless mass shootings, U.S. lawmakers are finally pushing some, albeit minor, gun control laws. Friday, breakdown. Let's go. Optimism extending to markets as Biden's relief bill finally catches up even with the NASDAQ. It added 2.5% yesterday, dragging other indices up. Now, I know I seem to have a pet peeve here, but let's just see if that rise is sustainable, because given the fundamentals, it's not. On the Bollinger Bands, we're looking at a second failed attempt to break out to the upside, which more often than not ends up kicking us down. And if we look at the weekly pivots, we're far away from R1. That double bottom has failed to deliver, and there's a good chance we're going to end the week with losses despite the fanfare. The dollar is also rising this morning after jobless claims came down to monthly lows. Much better than expected, 712K initial claimants and 414 million continuers. That's down about 5% for both, as the long-term 30-year bond shows a yield. 3% increase in yesterday's auction. This afternoon we'll be getting producer and consumer inflation data for February and Canadian employment figures at 1:30 GMT. European indices were all marginally up yesterday. Holland out front with a 0.84% increase, but Belgium down by about the same. The ECB held on to its current fiscal rates and confirmed that its pandemic aid bill would total about 1.85 trillion euros. Central bank head Christine Lagarde said she expects the zone's economy to grow about 4% this year, a recovery she is describing as uneven. Inflation is being revised upward from 1 to 1.5%, and echoing that this morning, CPIs from Germany show 1.3% for February year on year. That's up from January's flat 1, and a slight contraction on the monthly scale from 0.8% to 0.7%. The pound is reacting favorably this morning to a reduced trade deficit in January, down from £14 billion the month before to 9.8, and a less worse than expected 2.9% contraction month on month in GDP, still bringing the year-on-year number down to minus 9.2%. Construction also came in better than expected, a 0.9% month-on-month rise, but manufacturing and industrial production are dearthly down, the latter contracting by a ghastly 5% year-on-year in January. On the 5-minute cable chart, oh God, doesn't matter, we can see the reaction to the data decidedly positive, but nowhere near enough to pull us out of the dollar-instigated drop as the pair fails to cross R1 and drops towards the weekly pivot on this here hourly chart. Except for the Hang Seng, which is down 2.25% and spiraling. This morning is seeing Asian benchmarks gaining, with New Zealand's Dow 1.84% in the head. The trouble for Hong Kong, well, amongst its other woes, is a recent spike in COVID cases that's striking mainly the expat community. Meanwhile, across the Bay, China is cracking down harder than ever on monopolistic behavior. Courts have recently fined 12 companies, including Baidu, Tencent, SoftBank, and ByteDance. And in the works is what could turn out to be $1 billion fine for Alibaba, whose shares are nevertheless up 2.8% in New York and 1.7% in Hong Kong. Meanwhile, car sales in the kingdom are up 364%. Yes, you heard that right, more than triple, according to the local Auto Manufacturers Association, and the nation's Foreign Office has confirmed an upcoming meeting with U.S. State Secretary Blinken for next week. Monopolistic behavior is also on the U.S. agenda, as you may recall, with big tech appearing before Congress to defend themselves. Yesterday, Microsoft President Brad Smith accused Google of monopolizing the online news front. News sites, he said, can no longer sell online ad space on their own sites, but need to use Google tools to run and analyze them. Rolls-Royce yesterday announced a 29% drop in revenues to £11.8 billion, while BMW showed a 5% drop year-on-year to €98.9 billion. And so, with more lockdowns coming your way than going up, we wish you all a wonderful weekend.